Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Nicole, great presentation. I want to thank you on behalf of the ISE. You did a great job in covering a lot of material in just a brief amount of time, and that was just really well done. Let's take a look at the questions. Nicole, I have this question before I even read through everybody else's questions. If you looked at currency pairs and you saw one, and of course this applies to any tradable asset, one where the implied volatilities were much lower than another one, do you think that makes a better trade, or do you look at the trend in the implied volatilities, the absolute value of implied volatilities, or trends, or some aggregation of both?
Well, I guess there's three aspects. There's the difference between. Here, let me bring up a screenshot.
I got to go back. Question, wait 1 second. I got to give you the. Okay, you're good.
Okay. Oh, I forgot. Sorry about that. Before I answer that question, I do have the webinar schedule for Trade King coming up, so we have some great sessions planned for the rest of November. Please join us at 5 p.m. Eastern Time. And as I mentioned, we are covering technical analysis today about market tops and bottoms, and that session will continue until 6 p.m. this evening. All right, to get back to the volatility question, that is very popular question here. Here's a screenshot, as I mentioned, of EUI. And you have two volatilities on this chart. You have the implied volatility in the gold, and then you have the stock or the historical volatility of the underlying. So there's three aspects. There's the relationship between these two lines. There's the absolute number of the implied volatility, which is what Steve just mentioned. And then there's the comparison of the absolute number of the current implied volatility to its prior range, and that was what I was referring to with relative implied volatility analysis. For me personally, I don't put a lot of weight on the difference between the historical volatility and the implied volatility. I know some traders really like to focus on that. For me, it's more about two things: is where the volatility has been and where I think it's going, and also what is the absolute volatility number. Because if you're trading something that's got 60 implied volatility at the money, I mean that's a high number on its own basis. But I still want to know how it compares to where it's been trading. And so you need to be aware of both things together. And then the third item there is the difference between historical and implied, which I said I don't put a lot of weight on it personally. Great answer.
I mean, like you said, it's everybody has to have their own view, but I tend to agree with you that the difference between the implied and the historic is not something that I sort of like to trade. But I know some folks really do. So it's interesting you have the same philosophy. What's the account size required for trading the iron condor? Nicole, I know there's no general or right answer there, but can you do this in a one lot?
It's tough on a one lot. I believe, you can do it, but the reason I say it's tough is because you have less capital to overcome how much the commission costs and how the difference between the bid-ask spread for 4 different option legs. Those are very real obstacles to overcome with just trading a one lot. So that is tougher. But you can do it. It is possible. We don't have a minimum account requirement at Trade King, so you can open the account with 0, like I mentioned. Obviously, if you want to place a trade, you would need to do so and have enough capital to do that trade. We don't double margin iron condors, so that means that there is a margin requirement for the call side and the put side, or both, both call sides or both put sides, depending on which type of condor you trade. But because the underlying can only be at one place at one time, at expiration, only one of those sides can actually be in the money. And so we only require that you have one side for the capital requirement. We don't require both sides, which some brokers do. So they actually double the requirement, even though the risk is half that amount.
That's good for all of us traders. Philip has an excellent question. He says, so it's better to put the iron condor on at a very high implied volatility and ride it to a lower implied volatility. I guess that's the theory behind it, huh, Nicole?
That is the theory, but we didn't get into the full-on discussion of relative implied volatility analysis, and I go into this in that on-demand recording that I mentioned when I was at the ISC webinars last time. What you have to keep in mind, though, is that the higher the implied volatility, the greater the fluctuation will be. And so because we don't want a lot of fluctuation in the underlying for the iron condor, but you do want declining volatility, those two things are at odds with each other. And you really need to balance the benefit, or rather the increased juice or the increased premium that you might receive for higher volatility. When volatility is high, the option prices will be high, but you need to balance that to, there's a lot more stress, and there's potentially a lower chance of reward, because the increase in volatility could bring the underlying outside of the range that you need to be successful. So really, you don't want it to be really high, because that is just that would be quite a hairy trade, potentially.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.